Imagine you are sitting at your desk and you're, finalizing a quantitative execution model for a massive decentralized prediction market.
Right, high stakes stuff.
Exactly. So you're pulling continuous data directly from the exchange's public WebSocket feed, and you're piping literally billions of limit order book events into your architecture. And you are running all your standard microstructure analyses, optimizing your spread decompositions, calculating order book imbalance, estimating market impact, all of it.
Like any good quant would do.
Yeah, exactly.
Ah.
But what if your underlying data-generating process, specifically your algorithmic inference of which counterparty actually initiated the trade, is statistically indistinguishable from a coin flip?
Well, I mean, that is a terrifying prospect for literally any data scientist. You wouldn't just be optimizing noise at that point. Your entire machine learning pipeline would be aggressively learning the complete wrong economic reality.
And that structural inversion is the exact target of today's deep dive. We are looking at a really rigorous 2026 paper by Philipp D. Dubach. It's titled The Anatomy of a Decentralized Prediction Market, Microstructure Evidence from the Polymarket Order Book.
Yeah, and the empirical scale of this research is it's something you very rarely see in the crypto microstructure literature. I mean, the author didn't just grab like a few days of API data and call it a day.
Right, not at all. We are talking about a continuous tick-level off-chain WebSocket archive containing 30 billion events collected over 52 days.
Yeah, the off-chain archive is impressive on its own, but the methodological rigor really comes from what the author did next. They took that 30 billion event off-chain archive and they joined it with the authoritative on-chain smart contract data.
Which is a massive undertaking.
Oh, absolutely. Specifically, they extracted 255 million order-filled events over a 28-day calibration window, and then they mapped all of this cross-reference data to a pre-registered 600 market stratified panel.
So it's essentially a dual-lens data set.
Exactly. It allows us to observe both the real-time WebSocket feed that, most quantitative models rely on in production, and then compare it to the ultimate immutable truth that actually gets recorded on the blockchain.
So our mission today is to really unpack the mathematical reality of Polymarket's microstructure. For those of you who are out there engineering predictive models in this space, we are going to extract the core stylized facts presented in this paper. But first, we really have to explore this methodological bombshell that fundamentally challenges how data scientists handle order flow inference in decentralized finance.
Yeah, because before we can model the market dynamics, we have to audit the integrity of the data itself. And that data audit is where the paper just immediately breaks conventional wisdom.
Right.
If your pipeline is taking in off-chain data and trying to categorize trades as, say, buyer-initiated or seller-initiated, you are highly likely to be importing a catastrophic amount of measurement noise.
Okay, let's unpack this, because my immediate pushback as a practitioner is that inferring trade direction isn't exactly a new problem in data science.
No, it's a very old one, actually.
Right. In traditional equity venues, if you're working with a, quote, driven feed, you just rely on standard classification algorithms. We all know the Lee-Reddy algorithm, or the tick test. On a venue like Nasdaq, Lee-Reddy can accurately classify trade direction roughly 81 to 85% of the time based purely on, quote, feeds. So are you saying a WebSocket feed on Polymarket is structurally so degraded that we just can't apply standard TradFi logic at all?
Basically, yes. It is structurally entirely different. I mean, think about how the Lee-Reddy algorithm works. It relies on the relationship between the trade price and the prevailing national best bid and offer.
Right, the MBBO.
Exactly. But Polymarket's public WebSocket feed relies on this thing called a change side field. And relying on that field to infer aggressor flow is, well, it's like trying to determine who threw the first punch in a bar fight by only looking at who walked away with a bruise.
Wow, okay, that's a great analogy.
Yeah, it is purely a post-match state update. So it tells your pipeline which side of the limit order book experienced a change in depth, but it absolutely does not identify the taker who initiated the execution.
So if a quantitative model is blindly treating that change side field as the aggressor sign, what is the actual error rate when we match it against the truth?
So the paper proves this by taking those off-chain inferred buckets and validating them against the authoritative on-chain ground truth, specifically looking at the taker-assetted field in the smart contract logs. And when you volume weight the data across the top 100 market panel, the off-chain inference agrees with the on-chain reality only about 59% of the time.
59%.
Yeah.
With a market-clustered bootstrap, 95% confidence interval between 0.58 and 0.65, I mean, that is basically a random number generator with a slight breeze pushing it in one
A
direction.
very slight breeze, yeah.
How does that level of inaccuracy physically propagate through a quantitative microstructure model? Because it can't just be a minor glitch.
No, it's fatal. We have to look at the formulaic structure of the metrics you're calculating. Think about any standard direction-dependent measure like effective spread, realized spread, or price impact. They almost all take the format of an expected value, right? Denoted as M equals the expected value of sin sub t times a function of price, mid-price, and size.
Right, where sin sub t is your regressor sign. So an integer of +1 for a buyer-initiated trade and -1 for a seller-initiated trade.
Correct. So just consider the mathematical fallout here. If your sin sub t is wrong 40% of the time, that doesn't merely attenuate your signal towards zero.
Because the underlying variables aren't normally distributed.
Exactly, because the distribution of trade sizes and price states isn't uniform at all. A 40% error rate can completely destroy the expected value. Depending on the joint distribution of the error term and the underlying trades, it literally flips the sign of your output.
Wait, literally flips the sign, so positive becomes negative.
Yes. On that top 100 market panel, when the author compared the off-chain inferred effective half spread to the true on-chain effective half spread, the values flipped signs 67% of the time.
67%. So an algorithmic trading model isn't just degraded at that point. It's actively learning the inverse of reality. It assumes liquidity providers are, capturing a spread when they're actually paying it.
And it gets even worse when you look at market impact models. Like if you are calculating Kyle's lambda, which attempts to measure how much a unit of volume moves the price and, is notoriously fragile to begin with.
Very fragile.
The sign on Kyle's lambda flipped 60% of the time when using the off-chain feed. You are feeding your model the exact opposite economic narrative. Your pipeline calculates that a specific trade is driving the price up, but the immutable on-chain data proves it was driving it down.
So the absolute rule for anyone building models in this space moving forward seems crystal clear. Any direction-dependent microstructure work on decentralized limit order books cannot rely on the off-chain WebSocket, period.
Absolutely not.
You must source your aggressor sign from the on-chain event logs. There is no mathematical shortcut, and algorithms like LeReady will not save you here.
It's a non-negotiable constraint, for sure. But the beauty of this paper is that once you accept that constraint and you feed the corrected on-chain data into your standard econometric models, the true physics of the prediction market finally reveal themselves.
Okay, so if our trade direction was wrong 40% of the time, what actually happens to the classic microstructure models when we recalculate them with the pristine on-chain data? Like, what happens when we run the Gloss-and-Harris spread decomposition?
Oh, this is fascinating.
Just to level set for our listeners modeling this, we're talking about breaking the effective half spread into its two fundamental components, right? So S sub F equals C plus phi, where the transitory component, C, covers order processing and inventory holding costs, and the adverse selection component is phi.
Right, and when you run this exact decomposition on the top 100 panel using the authoritative on-chain data, the results are just startling. The median effective half spread, the transitory component, and the adverse selection component all collapse to essentially zero.
Wait, adverse selection collapses to zero? We need to ground that in physical reality for a second, because in traditional crypto microstructure, adverse selection represents toxic flow. It's the cost market makers bear when they get picked off by traders who have better, faster information. Are you saying there is zero toxic insider flow on Polymarket?
Economically, that is exactly what a zero adverse selection component implies. It means market makers are not systematically losing money to inform traders right after a trade executes.
That's incredible.
And what makes this so crucial is that previous papers which relied on that noisy 59% accurate off-chain data, they were generating a massive phantom adverse selection component.
So it's a ghost in the machine.
Exactly. The algorithm assumed market makers were constantly getting run over by toxic flow, but in reality, the algorithm just had the buyer and seller direction backward. The math was reflecting the flaws of the data pipeline, not the actual reality of the market.
Okay, here's where it gets really interesting. Once we strip away that phantom toxic flow, we have to look at the purity of the volume itself. Stylized fact 7 in the paper tackles wash trading.
Yes, the wash trading data is wild.
Right, because on unregulated decentralized token exchanges, the baseline assumption, which is often verified using multi-counterparty network classifiers, is that wash trading constitutes roughly 25 to 70% of total volume. It is a massive source of systemic noise for quantitative models. But Dubach applies a strict self-match and 128-block round-trip detection rule to Polymarket, and the results diverge wildly from the crypto baseline.
What's fascinating here is the sheer magnitude of that divergence. Across the 600 market panel, which encompasses about 6.4 million verified trades, the median wash share was remarkably low. We are talking about just 0.97%.
Under 1%.
Under 1%. Even at the upper tail, the absolute maximum capped out around 22%, which doesn't even reach the lower bound of standard unregulated token exchanges.
We have to explain the underlying mechanics of that massive delta.
Yeah.
Because why would algorithms wash trade relentlessly on a decentralized token exchange, but completely abandon the practice on a decentralized prediction market? Both operate on blockchains. Both use automated market makers or limit order books. So what is the structural difference?
It entirely comes down to the divergence in structural incentives. Think about why an algorithm executes a wash trade in the first place. On a token exchange, you have volume-tied listing fees. You have aggregator platforms like CoinGecko or CoinMarketCap that rank exchanges and tokens by total volume.
Right, so volume is marketing.
Exactly. And most importantly, you have market-making volume rebates. Algorithms wash trade on token exchanges because they are literally being paid by the protocol to inflate the volume, or because they need to trick an off-chain oracle into believing a token is highly liquid.
And Polymarket offers none of those incentives.
None. Polymarket contracts resolve into a single binary payoff in USDC. They do not list across competing aggregator leaderboards in the same way, and crucially, there are no volume-tied market-making rebates. If you wash trade on Polymarket, you are paying gas fees and crossing the spread for absolutely zero economic benefit. The incentive vector that drives 70% wash trading in the broader crypto ecosystem simply does not exist in this microstructure.
So we now have a verified data set. The volume is overwhelmingly organic under 1% wash trading, and we've corrected our aggressor signs using the immutable on-chain logs. With that foundation, we can finally map the physical shape of the limit order book itself.
Right, we can look at the actual architecture of liquidity.
Exactly. We need to look at liquidity and depth across probability vectors. Specifically, stylized fact 1, the longshot spread premium.
To map that, let's first contextualize the spread in the middle of the book. In the central probability, so when a market is trading between roughly 0.4 and 0.6, the median quoted half spread is around 400 basis points.
Okay, 400.
Yeah, and that is a completely rational expected spread for a decentralized prediction market. But when you look at the extremes, specifically probabilities below 0.10 or above 0.90, the spread spikes massively. We're looking at spreads ranging from 1,300 to 1,800 basis points.
Now, if you come from traditional racetrack or sports betting literature, your immediate instinct is to map this to behavioral economics. The classic theory is that bettors misperceive low probabilities, or they exhibit irrational risk-loving behavior when betting on long shots, and that warps the pricing. But jumping from 400 basis points to 1,800 basis points seems, I don't know, too severe to be a mere behavioral quirk.
It is entirely too severe for behavioral explanations. It is a strict mechanical liquidity provision constraint. Providing liquidity on binary contracts at low probabilities carries bounded upside but steep asymmetric inventory risk.
Let's walk through the math on that for a second.
Sure, let's look at the math for market maker. If you are writing a yes contract at a probability of 0.05, your maximum profit if the long shot fails is just 5 cents. But your downside exposure, the inventory risk you take on if that long shot unexpectedly hits, is 95 cents.
So the asymmetric capital efficiency completely breaks down at the tails.
Precisely. The inventory risk premium on the wide side of a binary outcome is mathematically much larger than on a continuous payoff asset like a stock. The 1,800 basis point spread isn't retail traders behaving irrationally. It is algorithmic market makers systematically protecting their inventory against extreme asymmetric downside. If you model prediction markets using continuous asset logic, your pricing models will fail at the tails.
Which completely shifts how we have to model maker behavior. But what about the depth of that liquidity? So what does this all mean for the spatial distribution of resting orders? Because in the quantitative community, there's a pervasive folk view that prediction markets are entirely top-heavy. The assumption is that all the money sits at level 1, the best bid and offer, and the rest of the limit order book is essentially a ghost town.
Yeah, that folk view is fundamentally dismantled by the special data in this paper, and Dubach proves it elegantly using the callback-Leibler divergence.
Right. I know the KL divergence is standard in machine learning for measuring how one probability distribution differs from a second reference probability distribution.
Yeah.
But how exactly is Dubach applying it to order book depth here?
So the author uses the KL divergence to compare the actual depth profile of the limit order book against a perfectly uniform null distribution. Imagine a grid where every single level of the top 10 book holds the exact same amount of liquidity, 10% at level 1, 10% at level 2, and so on.
A perfectly flat book.
Right. If the order book were perfectly top-heavy, meaning 100% of the liquidity was clustered at level 1, the KL divergence would be roughly 2.30. It would indicate a massive deviation from the uniform null.
So what was the actual measurement?
The median per market KL divergence on Polymarket is just 0.087.
Wow, that's incredibly close to zero.
It is. When you look at the physical distribution, level 1 only captures about 13.6% of the cumulative top 10 depth.
13.6% at the top of the book. That is barely a premium over the 10% baseline you'd expect in a perfectly uniform grid.
It's a very minimal premium, and from there, the liquidity gently decays to about 8% by level 10. The depth profile from level 2 through level 10 is practically a uniform geometric grid. Deep structural liquidity exists far beyond the mid-price.
That is wild.
And for practitioners, this is a critical insight. If your execution algorithms or slippage models assume a top-heavy book, you are optimizing suboptimally. You are assuming liquidity isn't there, limiting your trade size, when structurally the liquidity extends deep into the book.
This is exactly why empirical audits are so valuable. They clear away the quant folklore. But speaking of clearing away assumptions, we need to transition from the spatial distribution of the book to the temporal dynamics. How does liquidity behave over time, specifically as an event nears its final resolution? This brings us to stylized fact 8, which deals with omitted variable bias and statistical illusions.
Oh, this section of the paper highlights a textbook statistical trap that even advanced machine learning models easily fall into if feature engineering isn't rigorously checked.
Let's set the trap for the listener. If you take this massive data set and run a straightforward bivariate regression, regressing the log of the mean depth against the log of the seconds to close, you get a very distinct positive slope. 0.8178 to be exact.
Right.
And the immediate intuitive takeaway for a data scientist is that as the countdown clock approaches 0 and the market nears its resolution, the order book gets shallower. Liquidity pulls in.
And if we connect this to the bigger picture, we see exactly why that bivariate regression is lying to us. The author realized that time to close is highly correlated with other structural factors, so they ran a multivariate specification. They added 3 crucial controls to the regression: log market duration, log volume, and the price state.
And just to clarify, price state here is measured as the log of p times 1 minus p.
Exactly, which is the mathematical variance of a binary outcome, capturing how close the price is to the absolute extremes of 0 or 1.
Okay, so what happens to that 0.8178 slope when you introduce those 3 controls?
It completely collapses. The coefficient for time to close drops to plus 0.008. The standard error makes it statistically indistinguishable from 0.
It vanishes. So the countdown clock itself has 0 independent effect on market depth.
None at all. Time to resolution was just a mechanical mediator, basically a proxy for the actual drivers of liquidity. Depth on Polymarket is actually explained by total market duration markets that have been open longer naturally accumulate more resting limit orders.
Makes sense.
It's also explained by total volume, and it's explained by the price state mature markets that have settled toward extreme probabilities naturally carry different depth profiles because variance drops. If your temporal models feature a time decay parameter for liquidity, you are overfitting to an omitted variable bias. You are modeling the shadow, not the object.
That is a phenomenal breakdown. I want to push back on one other temporal element, though, because the paper also looks at microsecond dynamics, specifically Polygon's block clock alignment, which is stylized fact 3. We know the Polygon mainnet produces a block roughly every 2 seconds. As a high-frequency quant, my instinct is to look for, quote, updates statistically clustering around those deterministic block boundaries. Does the data show algorithmic clustering there?
It does, but it's a profound lesson in the difference between statistical significance and economic significance. Because the sample size is so massive, millions of discrete events, standard binomial tests reject the null hypothesis of uniform timing.
Right, the p-values are tiny.
Exactly. You can statistically prove that quotes do not arrive perfectly randomly. However, functionally, the distribution sits right on the uniform null of roughly 0.10 across the block interval.
Meaning the deviation from uniformity is mathematically detectable but economically useless for a trading strategy.
Exactly. There is no meaningful economic clustering of quotes on the 2-second block boundaries. High-frequency models do not need to optimize for polygon block times when modeling limit order book dynamics here. The network latency and off-chain relay stees essentially wash out the deterministic block clock.
Okay, let's synthesize these findings for our listeners. If you are a machine learning practitioner, a quantitative researcher, or a data scientist building execution pipelines for decentralized prediction markets, standard equity microstructure pipelines will mathematically fail you. Relying on off-chain WebSocket inferences like that change side field will result in a 40% error rate that literally flips the sign of your expected values. You must source your aggressor signs from on-chain ground truth.
Furthermore, you have to recalibrate your structural assumptions. When you use the correct data, adverse selection collapses to zero, revealing a market largely devoid of toxic insider flow. The wash trading baseline is virtually non-existent due to structural incentives.
Right.
The longshot spread premium is a mechanical inventory constraint, not a behavioral mispricing. The order book is not top-heavy, it is geometrically deep down to level 10. And your temporal models must drop time decay assumptions, recognizing them as statistical illusions masking the true physical drivers of volume, duration, and price state.
It fundamentally rewrites the quantitative baseline for this space. But there is one final piece of data in this paper that points to something much larger, something operating just outside the scope of the econometric equations we've discussed today.
Yeah, and this raises an important question, one that every practitioner modeling decentralized order flow needs to sit with. The author's data reveals a persistent 60-40 asymmetry across the 600 market panel. Specifically, the on-chain logs show 60% seller-initiated trades to 40% buyer-initiated trades. But this paper treated the immutable on-chain logs as the absolute ground truth without filtering for maximum extractable value, or MEV.
Right, because Polymarket settles on the Polygon blockchain. Polygon has a public mempool, and that mempool is a dark forest, actively crawled by MEV searchers and algorithmic bots.
Which introduces a fascinating layer of complexity. If algorithmic MEV bots are constantly sandwiching incoming retail orders, placing runner trades, or executing latency arbitrage via private relays like Marlin or Bloxroot, those algorithmic executions get recorded in the on-chain logs as taker events.
Right, they look like regular trades.
Exactly. So how much of that 60-40 retail aggressor flow in the definitive ground truth is actually just algorithmic arbitrage capitalizing on slippage? We assume decentralized prediction markets are perfect truth machines aggregating human beliefs. But when you are training a machine learning model on this microstructure, are you truly modeling human consensus? Or are you just measuring sophisticated algorithms fighting other algorithms in the dark forest of the blockchain?
You start the process worrying that your quantitative pipeline is built on coin flip off-chain data. You fix the data mathematically, only to realize your optimized pipeline might just be mapping the ecosystem of bots hunting in the dark. It is a brilliant, layered reality to navigate.